Well, I'm a clock builder, guys. I like to build clocks, and I know that most people want to know what time it is. So the presentation is going to have hopefully a lot of time telling for you, and it's going to have a little bit of clock building as well because some of the data that we look at is pretty detailed. And so instead of not sharing it with you, we elect to share it with you and try to help you understand it the best we can. So again, as an analyst in our team, what we do is we investigate, we analyze, and we communicate. And so we hope that we do a good job today of communicating what we're seeing. So with that, let me start. Okay, the first thing I want to do is just take a half a step back because this is the most important part of the investment process, and this is having your blueprints. And you've heard me use this analogy before, most likely, but it's like if we were a contractor and you brought us $1 million and said, build us a house. You might not want to do that because you wouldn't know what you're going to get. You might get a brick house, you might get a stick built house, a 1 bedroom house, a 2 bedroom, 1 bath. I mean, you'd have no idea. You would really require your contractor to get blueprints from an engineer, a certified engineer, and kind of have these, have a good set of plans to know where you're going to go and how the money's going to be spent and how the house is going to be built. Well, an investment policy statement is the same thing in the investment world, right? Before we start off building portfolios, it's always a good idea to sit down and build your blueprints. And in the investment world, we call that an IPS. And of course, the OnPoint risk tool and planning tool is a great place to start this investment policy statement and even produce a document. So I just want to review this really important document first because this is really the blueprints to leading us to what we should do. And investing is a client by client decision, right? Everything's custom built for every client. And so one client might want to be 100% risk off, and another client might want to be 100% risk on, and another client yet might want to be 50-50. And so that's okay. That's perfectly fine, and we'll talk more about that as we go through our cycle presentation. But in the IPS, there's two objectives. One is your return objectives. How much return do you need to earn or want to earn to make your life come true? And then two is what is your risk capability, right? And we really like to think and use OnPoint as the risk capacity tool and look at the drawdown because most people just look at standard deviation. That's really not the best way to measure risk. And so, really knowing your OnPoint score and what your required rate of return sets you up to have success in building your blueprints. From there, we have constraints. We have time horizons, taxes, liquidity, legal, and unique circumstances. And those are all things that we need to factor in as we build portfolios. And then there's, of course, you can see here cash flows and other items. So again, I just want to take a quick snapshot that, this is what drives me. If somebody says, Joe, how should I invest? What should we do? These are the things I'm going to ask you. I'm going to ask you, well, what's your return? What's your risk? What's your time horizon? What's your tax preference? What's your liquidity, legal, and unique circumstances? And the answers to those 7 pieces of information are what is going to drive my answer in building that portfolio. Okay. Now, this process isn't static. Isn't something that you do one time. This is something that we do over and over and over, and we encourage clients to check in and let us know at least once a year about how they're feeling. So step one is the investor needs to evaluate their situation, and of course we do the economic analysis, and that then leads to a strategic asset allocation decision, which then is communicated in the IPS. And then from there we measure, evaluate, and communicate the performance, and we monitor circumstances dynamically. Now, if there's ever a material change in those 7 pieces of information in the IPS, that really warrants a discussion on rebuilding the portfolio. Okay, making a remodel, making some changes. So again, if there's a material change in that risk or return or taxes or liquidity, legal or unique circumstances, then that's a good indication that the advisor and the client should sit down and talk about what we need to do differently going forward. Okay, with that, let's talk about cycles for a second. The reason that cycles are so important, as you're going to learn, is that how we invest really is influenced by where we're at in the cycle, right? And so as we're going to see, there's economic cycles, there's market cycles, and there's emotional cycles. And so all 3 cycles need to be considered when we're building and managing portfolios. So the cycle usually starts down here with low rates. Low rate causes growth, right? That growth then causes prices to go up and that gets higher inflation. And then to combat inflation, the Fed starts to raise rates, and that's the peak of the cycle. Then, because growth started to slow because the rates got high, they have to lower rates. Lower rates or lowers inflation by through the lower rates, and we're back at the bottom at the trough. And so on the left-hand side of the screen, we have the expansion phase, and on the right-hand side, we have the recession phase. Okay, now that is the time-telling slide. I'm gonna take you into the clock building slide on the next slide here. Okay, this is an eyeful, I know, but I'm going to break it down and hopefully make it really simple for you. This top panel up here, the green bars, this is like looking out of the windshield of the car. Okay, this is the economic car we're going to talk about today, and this is like looking through the windshield. This is where we're going. Okay, so when you drive your car and you look out your windshield, that's because you want to navigate and negotiate the road, right? Every once in a while, you're going to look at those blue bars, and that's the rear view mirror, and that's where we've been, or where we are right now. That's like the side view of the mirror, and then the orange bars are where we've been. That's like looking out of the rear view mirror. Okay, so the green bars are the windshield. Where are we going? The blue bars are the side mirrors of the car, and the orange bars are the rear view mirror. Now, what road are we on? What got us here? Those are the red bars. Okay, that's the Fed rate cycle. So let's start at the bottom. So you see that here, rates get high. Okay, they had to raise rates. We get a recession. They lower the rates. We get a lot of growth. We get so much growth that they have to slow us down again. So they raise rates. We get a recession. So once they break the economy, they lowered rates again. We get this long expansionary bull market. And then it started to overheat, so they raised rates, caused a recession, and so forth. So you can see the cyclicality starts with the Federal Reserve and the rate cycle. Okay, so what's interesting up here is that these leading indicators, the green bars, okay, when they turn negative, you can see here that a recession followed very quickly. But look what was happening with the coincident indicators. They were still positive. And look at the lagging indicators. The lagging indicators didn't really turn negative until the recession was over. Okay. The next period, you can see that the leading economic indicators turned negative, but there was a large gap before that recession started. And again, you'll notice that the lagging indicators really didn't turn negative until we were already through the recession. Okay. So fast forwarding to today, the leading economic indicators have been negative for quite some time. You'll notice that the coincident indicators have really held up well. The lagging indicators have really held up well. They're not anywhere near to being negative, okay? And the Fed is starting to pause. So we may not get a red bar this time, which indicates a recession. That's the soft landing that the Fed is hoping to architect. And it's looking like they might be doing that. Now, data can change, and we'll talk about that. But at the moment, and we're going to talk more about this in a few slides, it looks like they're going to avoid that recession. So that's how we look at that. We look at the forward-looking indicators, the coincident indicators, the lagging indicators, what the Fed is doing, and this is kind of our Ouija board, our roadmap to understanding where we're at in a cycle and what might be happening next. Now, let's look at this in another friendly slide. Okay, so here's the economic cycle. Up here, we start to recover back towards the midpoint. We swing past it, we hit a new high. And then usually what happens after we hit a new high is, we have to slow the economy down, right? And so we start coming back down, we hit a new low, and then we cycle back up. Now, what we're seeing the economy is really kind of flirting with kind of going from a little bit above the midpoint and really kind of skipping this downturn, trying to avoid that recession. And you see the red arrow going down here because we could still have one. There's still evidence that could prevail. But right now, it looks like we're just going to kind of flirt over here and start the cycle back up. Now, one of the reasons this is a little different this time is that most cycles in the past are because of economic activity slowing. This time, the Fed really was trying to battle inflation coming out of COVID. And that was where we've had the most Fed activity was focused on getting inflation down. The economy has still been pretty strong, and it's still data coming out today where the economy is still pretty strong. So the economy never really bottomed out during this cycle, right? We never really went from a new high to a new low. We really kind of have just skirted over the midpoint because we've been fighting inflation, and economic activity is still pretty robust, as we'll show you. Okay. Actually, let me show you one more thing here. I think one of my slides went missing here, but that's okay. Hopefully it'll come back later in the presentation. The other thing I want to show you here is we're going to put out a market cycle and an economic cycle piece. In my economic factor model, I've got about 50 factors that I'm looking at. And if all of those factors are bullish, okay, you'd think that that would be the best thing ever, right? Man, Joe's indicators are 50 out of 50 bullish. That's awesome. But what that means is we're probably up here at a new high. And what you're probably going to hear me say is, let's start to get a little more conservative. But you're like, everything's bullish. Why would we want to be conservative? Well, because if we're at a new high, at some point, we're going to start coming back down. That would be natural, okay? Now, I don't know how long that can take. And as you saw from the prior slide, sometimes it takes a long time. Sometimes it's very quick. But we would start to become a little more cautious. Now, the opposite is true. If my indicators are 50 out of 50 bearish, I'm actually bullish because that probably means that we're down here. And so this is kind of a contrarian concept, right? If I'm 50 out of 50 bulls, I'm actually a little more conservative and bearish. If I'm 50 out of 50 bearish indicators, it's so bad I'm kind of bullish. Okay. And so that's the emotional cycle. That's the opposite of the emotional cycle. Remember, the emotional cycle for the investor, up here, they are so happy. The stocks are up, the portfolios are up, the 401k is up, the house is up, everything's up. And we come to them and say, hey, let's move you to some cash. And they look at us like we're a two-headed monster, right? It's like, well, why would we want to do that? Everything's awesome. Well, because we could start coming down. Now down here, it's the opposite. Their 401ks are down, their house is down, their portfolios are down, and they are like, we come to them and say, hey, we want to take all your cash and put it in stocks. And they're like, no way. Are you kidding me? Everything's down. I'm feeling horrible. And so it's because of that feeling that the clients interject into the investment process that usually, according to the Dalbar study, shows that most clients buy high and sell low, because most clients wait until they're way up here. Everything's been so good. They're feeling really good. They're really confident. Now this is really true this time. Let's get in the market. And then we slide back down here. And then when we're down here, they're like, I can't get back in. I can't get back in. The market continues to go up. They're like, I don't believe it. I don't believe it. And finally, it gets back to the top and they start to believe it and they get in. So again, the client's emotional cycle, the emotional roller coaster, is usually the opposite of what the economic or market cycle is. So I just want to point that out so that we can have good discussions with clients and making sure that we try to remove feelings out of the investment process. We'll typically do a little bit better. Okay, let's just do a quick review on the markets. So for the quarter started off, July was a down month, right? Everyone was getting a little nervous there. We had a nice pullback, and then we started to recover, right? And we started coming up through August. September started off a little rough. We had a little pullback. People got nervous again, and then bang, it went straight back up. Okay, and so we ended up about 5.5% for the quarter. Now, it depends on the numbers can differ depending on the source and the measurement date. So again, that's why I'm saying it's about 5.5. But again, it was a positive quarter on the S&P 500. When we look at sectors, the utility sector, real estate, and industrials really were the leading sectors. And if you'll remember that these sectors are not utilities, but real estate and industrials, some of these have been sectors that were not performing as well earlier in the year. And then again, for the quarter, you'll see that S&P 500 and technology were really, down lower. Where if you look at those year to date, of course, they've been leading the market. Okay, so year to date, we have utilities, communication, and again, we see here the S&P 500 has really been, at the broad level, doing well, right? A lot of those cap-weighted stocks, the Magnificent Seven, right? The Amazons and Microsofts and Googles and Teslas and Nvidias have been really driving the market. But last quarter, we start to see that there was some more broader participation, right? The S&P 500 which is influenced by the capitalization weighting, was down towards the bottom, and we had a lot of other people coming to the party, and we'll see that theme continue here. Okay. Now, if we go to asset classes, we can see that real estate again has done very well for the quarter in gold, in mid cap, and small cap, and large cap. What's going to be interesting here is that we come down here to large cap growth and NASDAQ, right? And you'll notice that last quarter they started to cool off a little bit. They're very strong for the year, but they started to cool off a little bit last quarter because we had broader participation. So again, that evidence is being confirmed there. One of the best things you need to look at when you're looking at the market is supply and demand. Supply and demand drives all volume, drives prices up and down. And so here, what we're looking at are the supply numbers from the Lowry Research Group. First of all, at this top panel is just the long-term price movement of the Dow Jones, and we see that the 200-day moving average is still showing that we're in a long-term uptrend. So we're still in a bullish market there. And then when we look at the buying pressures on the NYSE buying power, the black line means that the buyers are in favor. That's more of a bullish indicator. And the red is that the sellers are in favor. That's more of a bearish indicator. So you'll notice here that for the quarter, we really started off and had, pretty much finished that quarter with a strong demand in favor. And that's why the market went up. And that's just a nice graph to show you that how that supply and demand started to change. Okay. Now we're going to look at the S&P 500 and its constituent. So last quarter, there were 399 stocks up and 110 stocks down. Again, you see the return was basically 5.53%. So it was a positive quarter. We had a lot of breadth. Again, there were some companies that struggled, but all in all, 400 out of the 500 stocks were positive. Now, on the left-hand side, you're going to see the stocks that contributed to the returns. And on the right-hand side, you're going to see the stocks that detracted from returns. And what's really interesting here is that you don't see a lot of those usual names, right? You don't see the Microsoft, Googles, and Amazons, and NVIDIAs. Those really weren't what was driving the market last quarter. Again, Tesla was up here, which is, in the top 14. But again, you'll notice that a lot of these names, most of you probably don't even know who they are, okay? So again, that continues to show that we had some broader participation last quarter. Okay, are we going to have a recession? Well, no one really knows, but if we look at the consensus data from Bloomberg, their survey shows that there's about a 30% chance of a recession over the next 12 months, so it's quite low. When we look at one of our models, internal models, we're going to notice that right now we're about 50% bullish, 25% bearish, and 25% neutral. So again, our bearishness is about 25% on the economic cycle, and that's really close to that 30% of the consensus estimate. So again, I won't go through each one of these, but you'll see that out of these 8 factors, we have 4 that are bullish, 2 that are bearish, and 2 that are neutral. When we look at the yield curve, right, the yield curve being inverted is a sometimes historically been a indication of a recession to follow, and so we want to take a look at that. Here, what we're going to see is that at the beginning of the quarter, this is the yellow line. This is where rates were on 7/1, okay, and this green line is where rates are now at the end of the quarter. And so you'll see that the whole yield curve has shifted down, and you can see the changes here. So that's good that this yield curve yields have come down. As anticipated, this has been even before the rates have been cut. The bond market, this is the 10-year Treasury and all of the different Treasury bonds. So here you can see the 1 month, the 2 month, the 3 month, all the way out to the 30-year Treasury, and their different returns. So again, this isn't the Fed funds rate. This is the U.S. bond market. But again, rates are kind of looking at the Fed and their actions, where rates might be going, and this definitely influences the yields. And so we can see that yields have come down over the quarter. Okay, this next slide I know is a clock building slide, but we're going to get through it. What we're looking at here is we're looking at the ISM indexes, the GDP, the gross domestic product, and the Federal Reserve. And so again, we showed you some economic indicators earlier. What we're showing you here now is how we measure and predict economic activity in the economy. So 2 of the best ways to predict the economic activity in the economy, looking out of the windshield of the car, right, of where we're going, are the ISM indexes, the manufacturing and the services index. This red line is 50. So anytime that these numbers are above 50, that's an expansionary. Anytime that these lines or numbers are below 50, that's contractionary. And so right now you can see that the services is well above 50. Manufacturing has dipped below a little bit, right? And that's a little bit concerning, but it's really close to that 50 line, okay? What we're looking here, these blue bars in the middle, this is where we've been. This is the rear view mirror. This is GDP, right? GDP is measured after the fact. But you'll notice that GDP has still been positive for quite some time, okay? So the economic activity looks pretty good if we look through the rear view mirror, and it's looking okay looking through the windshield of the car. And of course, jobs are, we throw jobs in there and inflation expectations and things like that as well. But this is just looking at the measurements of the economic activity. On the bottom panel, again, this orange line are the rates. This is the Fed, and this white line is the market. And so you'll notice here that as the market anticipated the Fed cutting rates, that the market has been running and had a great quarter even before we saw the Fed starting to cut rates, because it was the anticipation of the rate cuts that's driving the market, okay? And so we can kind of see that the market is cheering that. Now, if we do go into a recession, if that ends up being a hard landing, then we're going to see, we would expect this market obviously to pull back. But right now, the market is in a positive mood because of it looks like we're changing the inflection point of the cycle by the Fed starting to cut rates. Now, how fast they cut, we don't know. There's some really strong economic data coming out, which sounds good, but if the economic activity gets too good and the economy is overheating, the Feds are going to raise rates. They're not going to cut rates. And of course, that would be bad for the market. So again, we don't know how fast they're going to lower rates, but that's what we need to watch. And again, if the economic activity or inflation heats up too much, then we may get a pause and even an increase in rates. Okay, so we're just going to watch that data. But right now, it's the market is liking what it's seeing when it comes to the economic data. All right, let's talk about what drives the market. So far we've been talking about what drives the economy. In the economy, the market is one of the leading indicators of the economy, and the economy and the market do not have to be going in the same direction. So again, what we see here in our indicators, we see about 80% bullish, 20% bearish, and so again, we're seeing that confirmation as we saw through the sector returns and the economic data. But right now, we're more in a bull market than we're in a bear market. Obviously, there can be pullbacks, but that long-term trend is still looking to be intact. Okay. When we look at the factors that drive the markets, the same things over and over and over. It's inflation, interest rates, corporate earnings, the Fed, and geopolitical events. And so, as the chart shows, if inflation's going up, that's negative. That's a bear market. If interest rates are going up, that's a negative and bear market. If corporate earnings are going down, that's bearish. If the Fed is restrictive, that's bearish. If there's a lot of geopolitical events and volatility, that can be bearish. On the other side of the coin, if inflation is coming down, that's bullish. If interest rates are coming down, that's bullish. If corporate earnings are going up, that's bullish. If the Fed is accommodative, it's bullish. If the geopolitical events are calm, it's bullish. And so as we evaluate these factors, we're always using fundamental, technical, and economic tools to evaluate this, okay? And this is how we can identify where we're at in a cycle by following these factors. Okay, so let's look at each one of these factors in a little more detail. So inflation. Inflation is coming down. So here, up here, this orange line is the rear view mirror. This is the PCE. This is where we've been. The red line is the road. This is where the Fed wants us at 2%. And the white line is looking out of the windshield. This is the University of Michigan's 5 to 10 year outlook for inflation. And so what's important here is that the outlook is 3. The current PCE is at 2.2. So, inflation's moving in the right direction. When inflation moves down, stocks move up and vice versa. Okay. If we look over just at the next 1 year, so if we look at the University of Michigan's 1 year median expectation, okay, this is still 2.7. And then the CPI index, where we've been looking out of the rear view mirror, we've been about 2.5. Okay. So inflation is there's still a chance that it can rear its ugly head. But right now, the data shows that it has been coming down and the Fed's actions have been working. When we look at the 10-year Treasury rate, right, this is something that affects the markets. In general, when rates come down, stocks go up, and that's what we've been seeing. So that's why that's positive. Let's turn to corporate earnings. Corporate earnings is really, to me, probably the most important thing to watch, because this is really the economic activity and the engine that drives the economy. Right now in the S&P 500, the trailing 12-month earnings have been 233. The 12-month forecast is 237. So that leaves you about just shy of a 2% growth rate, which is down from historical average that's probably closer to, let's say, 6%. And last quarter and a few quarters prior, the expectations were even higher. But because the markets have had such a strong year and have run, those earnings estimates have come down. Now, they may get revised, but again, if you start with a high number and the market runs, then you've grown into those earnings, and that's why they're a little bit lower right now. Now, if we look over the next 3 years, this blue line here, it corresponds with this headline expected earnings in 2025 at 274. And then the next year, 2026, is at 302. And then 2027, again, the consensus headline estimate is at 321. So in general, they're not straight lines up, but earnings are still projected to go up. And when earnings go up, stocks go up. If earnings go down, stocks go down. So again, this is how we read our Ouija board. Okay, this is how we read and monitor those factors that we talked about, those 5 factors that drive the market. Now, when we go to what does all of this mean, based on consensus estimate, there's still about an 8.87% return in the market over the next 12 months. The consensus estimate is 62.61, and we're currently at 57.51, again, on October 5th when I put these slides together. And so there's still some room to run. Now, it doesn't mean that we will, but that's what the consensus estimates and analysts are predicting. When we look at the Fed funds rate, right? There's rates can mean 2 things. When we say interest rates, we can mean the 10-year bond, or we can mean the Fed funds rates. And so again, here what we see are the dot plot. This is what the Fed governors say they're going to do. The gray dots are where it was obviously where the rates were expected to be as of the last meeting, and the yellow dots are based on the most recent data. And so you can see again they're in the right direction. They've come down. They've come down. They've come down. Okay, so again, rates coming down, that usually means stocks go up. And so again, the rates are favorable for the market at the moment. This next slide is an eyesore, and it's very interesting, and it's very difficult to understand. Geopolitical events. Well, the best way that I know to measure the risk in the market on a daily basis, and the wars and shortages and elections and all the things that are going on, is the VIX index, the fear index, right? And so what we see here is volatility, risks remain high, but volatility is really pretty low. So although we have the Ukraine and Russia war, and we have the Middle East crisis, and we have elections, and we have hurricanes, and we have all kinds of geopolitical issues going on, the long-term average, that long-term risk in the market is, really below average. It's just right at average. It's actually, 17 versus 18. So it's just right at average. And so it's not out of control, right? We do have spikes, and it came right back down. Obviously, this is COVID, big spike, and it came back down. But all in all, we're below the long-term average. Now, if we want to know where we've been, we can see here that risk has been up. So the rate of change on the VIX, it's been up over the last 18 days. And we can see that, right? A big spike here and a spike up. So it's been up. However, if we try to look at an indicator that shows us where we might be going, anything below 50 means that it might turn around. Anything above 50 means that it's probably going to continue in the direction that it's going. So here, because it's been going up, and we're below 50 here, 0.5, this kind of means that it's probably going to continue to come down, which it looks like it has been. Okay, so again, it's very interesting that there's all kinds of geopolitical risks out there, excuse me, but the market has been very resilient, okay? And it's been a very volatile geopolitical year, and we still have an election to come, right, within 30 days, but risks, and the market's kind of been looking past some of that, and that's just very interesting. Okay, so what's the outlook? Well, we're pretty much, neutral across the board on all asset classes. Again, I think there's that bull market, that new cycle that is ready to come, and it looks like it's starting, but I don't think we're out of the woods yet. So we're cautiously optimistic. We have those elections coming up, and so I think once we get through the elections, we'll kind of have a better understanding. The markets might give us a better direction. The Fed and the data might give us a better direction. And so again, we want to be bullish. The data looks good, but I would really like to get through these elections and see if this is going to be a new cycle, or if it's going to be a fake out, and the Fed's going to have to pause again or even increase rates. So it's cautiously optimistic. Okay, and again, we would maintain a balanced portfolio. We wouldn't be in all cash. We wouldn't be in all stocks. We think taking a measured approach is still appropriate right now. Again, that has to be in line with each individual investor's IPS. So again, if you got young clients, or if you are a young client and you have 30 years left, you can be a lot more bullish because you're not going to be as concerned with a pullback over the next year or so. If you're in retirement or nearing retirement and you've been all equity, you might want to be pulling back and getting some fixed income and some risk off assets in there, putting a fixed index annuity into your portfolio. So again, I think that a moderate portfolio right now, when I do the math and science, and I do have a new book coming out on this, so we'll get that to you here shortly, that, the moderate portfolio should have about 20 to 30% fixed index annuity in the portfolio to really be that defensive player and buffer the risk and really support the offensive players in the equity portfolios and in the multi-manager portfolios. Okay, so again, there's return generators and there's principal protectors, right? There's offense and defense, and so knowing when to get your offense on the field, knowing when to get your defense on the field, and keeping that balance is an important thing. So when it comes to the market right now, I think for most people a balanced approach is appropriate. But again, that's a general statement. Don't take that as advice, because we would need, you need to sit down with your advisor and look at your own IPS and your own circumstances. But at a very high level, based on the data and the forecast of asset classes, I'd still be taking a moderate approach. Okay, so where are we going? Well, how are we going to look where the market might be going? Well, we saw that the consensus estimate still had about an 8% return in it. So again, here we look at the last 18 days where we've been, and the market's been up. Okay, and again, remember this indicator here, if it's above 50, means it's probably going to continue in that same direction. So at 0.9, that's a strong evidence that the markets are going to continue up. Okay, now it's no guarantee. These aren't guaranteed signals. We can't predict the future, but it's the best indicators of math that we have. So again, right now, based on the data, it looks like this market trend should continue. Okay, now it doesn't mean it needs to continue at 6% per quarter, but it still doesn't look like it's ready to revert and back into a pullback. At least not a pullback over an 18-day or 30-day period. So again, we see this chart. What does that all mean? It means we have, just a little bit over almost a 9% expected return in the market. The long-term expected return in the market is 7%. So again, long-term trend is at 7. If we're at close to 9, then that means that we're on an outperform call right now. It looks like the market should outperform its long-term average. So we can also observe returns by looking at the seasonality. And so what we're looking at here is we're looking at 10 years of data on the S&P 500 month by month and the average return. And so we're in October, okay, and typically over the last 10 years, the average return on the S&P has been 1.59. November's been positive and December's been positive. So again, a positive quarter. We do have an election in here, but again, election years are typically positive 80% of the time. And so it's nice to observe the data. Now, this year, right, so far, and it's not through October, but the market pulled back, so it's breaking that trend. In 2023, again, the market was down in October, so it was breaking that long-term average. So it is possible the market ends up down, but historically, the average over the last 10 years has been a positive seasonal effect, as well as November and December. Now, what about the VIX? What about the risk? What's its seasonality? Well, here we can see that the VIX in October is usually up. So that means volatility is usually up a little bit in October, right? And here we see that November is down. So it's usually the risk is usually down in November. And then long-term average is that it's popped back up in December. So again, we were looking at both risk and return. That's why we do that, because remember in the IPS, we need to look at both risk and return. And so we want to look at both sides of that investment coin. So the outlook is, don't fight the Fed. It's really, you don't want to really fight the Fed. The market is expecting, more rate cuts. Are they already priced in? Yeah, probably some of them are. So if we don't get rate cuts, the market could have a little hiccup. It's been pretty resilient as we've been talking throughout the year. When the Fed hasn't given the rate cut that it was expecting, the market, still stayed pretty resilient. The recession, the yield curve is still inverted, but it's shifting. The LEI indicators are still negative. So there's maybe a recession will emerge. The consensus estimate isn't expecting that right now, nor is the Fed, but that could change. But so again, we're not 100% green. That's why we're still kind of just cautiously optimistic. There's definitely an increased opportunity for active and tactical management in asset allocation as well as stock selection. But again, with stock selection in the individual equity portfolios, you have to be patient. It has been a buy and hold year. The buy and hold factor has been in favor over the technical factors, okay? And so there's years that you want to be more active and tactical. There's years that you want to slow your roll and be more strategic and more patient. And so this is one of those years is that just holding some of those high quality stocks and being more patient has been prevailing over some of the portfolios that try to, go in and out of the market and trade every month. Okay. Again, corporate earnings, they've been resilient. They look positive. So that really brings me some comfort. We're still watching, lots of other factors like unemployment and wage growth and things like that and top line growth, but the earnings have been positive. Geopolitical events are still a factor, but they're very hard to model. And a lot of the time you don't get what you think you're going to get. Again, when the Ukraine-Russia incident started, the market, started going up. So sometimes the geopolitical events don't, the market doesn't react to geopolitical events as one would think. Okay, so for the clients on the call, you want to have that IPS. You want to hold enough cash to make you comfortable. You want to have enough fixed index annuities in your plan to make you comfortable. You want to update your financial plan as necessary. Again, if there's been a material change in your investment policy statement factors, you want to let us know so we can update your blueprints. So again, it's communication, right? Communicate your changes in your willingness and or ability to take risk. For the advisors on the call, you should probably be updating your clients' on-point risk score a couple times a year, or at least once, a year, or at whatever periodicity is appropriate for the client to make sure we know where their tummy test is and we know what that risk score is. So it's not a one and done. We want to give those risk assessments continuously. What are we going to do? We're going to listen to you and adjust your IPS and financial plan as necessary. Okay. So again, it's success is a two-way street. The sender and receiver need to be on the same page. So you need to be communicating. We need to be listening, and then we can keep you on the right path for you. We're going to continue to manage cautiously. We're going to monitor and adjust like we always do. We're going to investigate, analyze, and communicate. And that's what we feel is most transparent, is to get out here once a quarter. Also, we put out videos and writings every week and every month. So please, we encourage you to pay attention to those. They will help you in between the quarters to stay in tune with what we're thinking. So that is what we would do. So with that, we thank you very much. Of course, make sure as you get a copy of this presentation that you're looking at these disclosures. They're very important. We take compliance very seriously. And so please definitely note that there's disclosures with these presentations. So with that, I want to thank everyone for their time.
The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.